Good morning. Welcome to Stock Market Today. It's Thursday, December 3rd, 2020, and I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. Find me on Twitter at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where we get a lot of the content for this show. We also give you daily stock ideas to consider. Hits your inbox every trading day before the market opens. So U.S. equities finished mostly higher on Wednesday after opening lower. Sector performance was mixed, with energy leading. Comm services and financials also outperformed. Materials, the consumer sectors, and technology lagged the broader tape. Treasuries were mixed, with the curve steepening and with reports highlighting 18-month highs in inflation break-evens. Remember, rising inflation has been a big part of our theme over the past few months. Dollar was stronger versus the yen, but weaker on the euro cross. Gold finished up 60 basis points. WTI crude up 1.6% on the day. And as we get to the desk here, start recording this morning, S&P futures are down about 10 basis points after Asian equities were mostly higher overnight. European equities are lower, extending this week's pullback. Remember, Europe had been strong. Treasuries are mostly firmer with some curve flattening. The dollar is weaker against the yen and sterling, while little changed on the euro cross. Gold is up 40 basis points. WTI crude is down 70 basis points to kick us off on a Thursday morning. That starts with the S&P and the Qs closing at new all-time highs, or starting the day after closing yesterday at all-time highs. We're going to bump up the SPY's near-term support to 360, but the key level remains that 340 mark. I think as long as we're above 340, you have potential upside to the 413 level. For the Qs, 260 remains key support. Right, we need to see a few more closes above this breakout level at 300, although we have fulfilled our obligation of attacking the September highs while trading above 280. So that playbook largely coming to fruition as well. IWM, a little bit of a consolidation here in the near term, support at 170, then 160 below that. Structure of the market remains as it has been, with our playbook really kind of playing out, if you will, right? Consolidations within the context of the uptrend that were likely to resolve to the upside have done so. So we'll continue to monitor the situation. We continue to feel that the path of least resistance is to the upside. We've highlighted the important support levels, and as long as we're above those, it makes sense to have a bullish tilt. Obviously day to day, you want to adjust how aggressive you want to be. We'll talk about some breadth divergences that we're beginning to see that could have some near-term implications, but bigger picture trends remain largely intact, and our reviews remain unchanged. Hitting our market in a minute now. What are we writing about in the note today? Well, it is Thursday, so we'll touch on breadth. And breadth remains strong, but we are mindful of the divergences. SPY and Qs closed at record highs. We touched on that. 90% of the stocks in the S&P 500 above their 200-day moving average. And I have to ask, is that too strong? What's interesting is if you kind of go back and look at instances where this metric has crossed above 90%, as it has now done, over the next 6 months, the market can be choppy. With actually higher odds of slight downside. So that's why I ask, are we too strong here? Home Construction ETF begins to lag the broader market. We'll touch on that. That's ITB. And futures point to a mixed open here this morning. Taking a look at the major indices, green on the screen once again. Chaikin power bars remain bullish across the board, just to varying degrees. So the Dow adds 25 basis points, 4-0, pitching a shutout. Bulls to bears there for the Dow. S&P 500 up 22 bips, 122 to 44. NASDAQ Q's up 13 bips, 14 to 11. Bulls to bears there. Small caps up a like amount, 813 to 166 on the ratio. Bonds down tick, sending yields higher. And I am, there is some talk about a potential breakout in yields. And when we touch on the home construction ETF a little bit later, I think it's important to keep in mind that we're starting to see some relative weakness in home construction as yields are backing up. Energy, our strongest sector, once again, up 3.25%, 3-1 bulls to bears. According to the Chaikin Power Bar, small cap stocks and large cap stocks are strongly bullish. The major indexes are mixed. So let's run our screener, and kind of sticking with this pattern of identifying bullish opportunities on Tuesday and names to avoid or potential bearish opportunities on Thursday. What I did here was just kind of take note of the fact that we are starting to see some divergences in breadth. What does that mean? That means your risk management process has to be key. That means you have to be selective. That means you want to really have an appreciation for names you want to avoid. Now, if you also trade to the bearish side, these could be interesting setups as well. So I screened the Russell 3000 for names that have a neutral minus rating or worse, based on our 20-factor Chaikin Power Gauge model. And then from there, I wanted the names that are overbought with weak money flow and weak relative strength. So if you think about what these names are and what they look like, overbought within the context of downtrends, underperforming, and with money flow weak, some signs of distribution. So screen return 26 names that you might want to avoid if you own them. Maybe they're a source of funds for you, or if you potentially look to trade to the bearish side. Maybe there are some opportunities here. Some of the higher profile names, New Relic, NEWR, MasterCard, MA, AYX in here as well. Cabot Oil and Gas bucking the recent strength in the energy space. So have had a lot of good feedback on these screens, so we'll continue to run them, and hopefully you're finding them helpful. As always, I am open to feedback, so please, you can find me on Twitter. My direct messages are open. Give me a shout out, and I'd love to chat. Let's hit our sector tracker now, looking at the movement over the past 5 days for the major sectors of the ETFs. Comms at the of the S&P 500, rather. Just apologies. Comms at the top of the list. That's an encouraging sign, because a lot of the big internet names live in that space. Healthcare's been weak relative, so this looks like a counter trend rally. Tech, we've talked about what happens if tech gets back in gear in our notes. Obviously, we think that would be bullish. Financials continue to perform well, and staples are positive ever so slightly over the past week. Discretionary materials and REITs are middle of the road, slightly lower. Utilities, industrials, and energy at the bottom of the list here in the near term. But note, we have been noticing substantial improvement within the energy complex. So just something to keep in mind if you're looking for potential turns. We've kind of highlighted where these turns in relative strength have played out roughly over the past 5-6 months. Remember, we started with the materials; they were doing well. Then it was the industrials, which continue to do well. We started to highlight the financials, in particular the banks, and now I'm hard pressed to be bearish on energy here in the near term. So if you're looking for ideas, there's a lot of opportunity out there. Taking a look at our industry in focus, healthcare equipment services, past 6 months, let's call it an inline performer, outperforming the S&P by only 14 basis points. Power bar ratio, which measures future potential, is weak, 12 bears for 11 bulls. It's currently ranked number 17 of 21 subsectors. Let's look at some of the indicative names there, names you certainly want to avoid based on those power gauge ratings. Tandem Diabetes, TNDM, iRhythm, IRTC, and Silk Road Medical, SILK, all with very bearish ratings. Now, the fund itself has been propped up, and it's in an uptrend, but it does have a neutral rating above the rising long-term trend line, starting to see some bearish money flow, closer to oversold than to overbought, but we're keying on the diminishing relative strength as well. So there might be some opportunities in here. Again, there are 11 stocks that do have bullish ratings. So it's going to make sense to be a lot more selective if you are looking within the space, and recognize, if you go to my work from Tuesday, my relative strength work, we know that healthcare has been an underperforming sector of late. So just kind of something to keep in mind. Healthcare is broad, however, so you really do have to drill down to the industry level. And this one's okay. I mean, it looks to me like a true neutral, if you will. So I don't know, probably better opportunities if you're looking for long ideas. Let's turn around now and see what's trending. Yesterday's S&P 500 movers and shakers, our gainers and losers, NetApp or NTAP, however you want to call it, up 9.3% following their earnings announcement. No news on HollyFrontier. Energy was strong, right? So HollyFrontier, Valero, APA, and Devon go along for the ride. I think that was largely driven by some of the crude inventory data that was released yesterday. So nothing company specific, but you're seeing it, right? This is happening right in front of you in real time. This shift in the energy space, it's fascinating to watch. And it speaks to not remaining dogmatic, right? I was a table pounding bear on energy for 2 years, pretty much. But there appear to be shifts. There appear to be shifts under the surfaces. We highlighted energy services right on this show and in our notes, and you're just starting to see some changes playing out. So, and then the inventory data also helping here as well. So those names moving higher on the day yesterday. Loser side of the board, Salesforce.com earnings announcement, as well as their deal for Slack, send that stock lower by 8.5%. Whirlpool, nothing company specific, down 5% yesterday. Very bullish stock. And I'll note that it was added to the focus list at JP Morgan this morning. GPC, Genuine Parts, down 4.6%, following a Bank of America Merrill Lynch downgrade, weighing on the name. ROL down 4%, Pool down nearly 4%, nothing company specific to drive trading there. Let's talk about breadth. Breadth is strong, but some divergence. All right, so percentage of stocks above their 200-day moving average, solid, 91%. But remember what I said, since 2011, it's a small sample size, but very small sample size, actually. About 11 times we've seen it cross above 90%. And that generally has led to some choppy trading over the next 6 months. But, we have to take everything with a weight of the evidence approach. In the near term, I'm more concerned, not concerned, but I'm more mindful of the percentage of stocks above their 50-day moving average not confirming this week's S&P 500 highs, not making a newer high. And the same goes for the advanced decline line. Remember, the advanced decline line broke out ahead of the index. But now with the index making new highs, the index being the S&P 500, we actually have a slightly lower high for the advanced decline line. Just something to be aware of, right? Your risk management will dictate getting more defensive if these divergences are confirmed by a move lower in price. But we want to be mindful. When you're thinking about adding new ideas to the portfolio, you want to make sure that they're high conviction ideas. Anything marginal should probably be left to wait. I think it should always be like that, but I understand some of the exuberance that builds up in the market. You see stocks that are running, you want to chase them. I think I always think it makes sense to be selective and at the very least, have an understanding of the environment that we're in if you are in fact chasing names. Home construction begins to lag. And this is ITB. I know a lot of people look at XHB, which is obviously much broader and more indicative of the home building supply chain. This is the home construction ETF, ITB. And you can see here, it's been choppy, right? Little to no progress since the end of August. Consolidation, you can see support here, but look at momentum waning, right? A series of lower highs by the RSI, and on a relative basis, a series of lower highs and now lower lows as well. So home construction, which had been a hot space, obviously, has really tempered its absolute and relative trends here in the near term, and we are actually seeing signs of relative weakness. So something to be mindful of if you're involved in that space. You want to keep an eye on that. Make sure your risk management process is well honed as it should always be. But we'll see how it plays out. Maybe it's just a consolidation through time that needs some more time to play out. However, you have a pretty solid line in the sand here at about 52.5 on the ITB as relative strength is shifting to the downside. Capital markets, on the other hand, traded at a new high yesterday. Look at the difference here. KCE, Capital Market ETF, it's relatively illiquid, but there are 24 names in there that we rate as bullish or very bullish at Chaikin Analytics on a fund that is breaking topside on a relative basis. So that's going to wrap us up for today. Have a great Thursday, everyone. Take us for a test drive. I'm back with you tomorrow.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.